Hello friends. Hello friends. Welcome to a new webinar of Proficient Group. I am your friend Shumoy Goswami, and today it is 30th of June. As you are aware, every Saturday we conduct a new seminar, a new webinar rather. Alternately, we do a topic on current market analysis and topic on academic interest. Today, we will be doing a discussion on some classical technical analysis signals. And today we will be talking about the basics of Dow theory and today's interpretation of Dow theory in modern market, and how to discuss or how to identify the bullish and bearish markets, the long-term bullish and bearish markets at an early stage of trend reversal, right? So I believe this will be a topic of utmost interest for positional traders, because if you can identify the trend at an early stage, whatever I'm talking about is primary trend, and I'll be defining the term primary trend very soon. If you can identify the primary trend, and these trends last for a very long period of time. These trends last for a minimum of 6 months, and for a very long time, say 2 years, 4 years, 5 years time period. And we can see extended price rise, extended price appreciation in this period. Stocks go nearly 2 times, 4 times, 10 times, and that is what happens in a primary bull market. The reverse is what happens in a primary bear market, when stocks fall vigorously for an extended period of time, for 6 months or till 2 years. So these trends are actually the building blocks of the chart, right? The chart is made up of these trends, and our objective as a trader is to identify the trends and trade in the direction of the primary trend. So if we can do that, then the odds of success increases hugely. So having said that, let's come back to today's topic of interest. Today we will be talking about the Dow theory. So let's start with that, and let's see how Dow theory can help us in identifying trends at an early stage. There are basic principles of Dow theory. The Dow theory is, let me first do some introduction of Dow theory. It was Charles Dow who formulated the theory, not the theory as itself. He was basically a journalist in Wall Street magazine, that is the world famous magazine nowadays. So he was a journalist, and at around 1890 till 1900, he formulated some principles. These principles were not meant to predict the stock market. His principles were basically meant to gauge the mood of the economy, and stock market is nothing but a thermometer of the economy. So later on, after his death in 1902, his students Hamilton and Robert Rhea, they actually went on to formulate his findings, his principles into certain theories, whatever we know it right now. And 6 basic principles were formulated, 6 basic tenets were formulated, that I'm talking about early part of 20th century. And these principles are actually the building blocks of technical analysis. Charles Dow, after whom the global index, the US index, the Dow index is named, is said to be the forefigure, the father of technical analysis. With these findings, the technical analysis started to take its stride, right? So let's start with Dow theory, the principles of Dow theory. I'm giving you a brief introduction to the 6 principles of Dow theory. Yes, there are 6 principles, and the first of them is that uh, the market, by the term market, we are actually implying the index, right? You can take the Nifty index, you can take the Sensex index, whatever. The market actually moves in phases, right? Whether there is a bull market or whether there is a bear market, these phases come alternately, right? After the bull phase, there is a bear phase, there is a recession, then the recession ends, then another bull market begins, and all those things. So market moves in phases, and within these phases, there are 3 distinctly visible movements during that phase, each phase. Suppose it is a bull market, and in the beginning of a bull market, we generally see accumulation phase, right? Accumulation phase means that prices, after a prolonged correction, have been steady. They are no more depreciating, but interest is lost. But the correction have been so huge in the stock prices that investors have lost their interest, and prices are now not depreciating but not appreciating either. They are consolidating in a choppy range for a small period or for a large period, and this period is generally called as the consolidation phase. In this consolidation phase, an important thing happens, that is the the informed investors actually get into the market, and the uninformed investors, they being bored, and they get out of the market. They have taken all the pain of an extended bear market, and now they cannot withstand that pain anymore, and they're getting out of the market. And the informed investors, those who are in the know, those who can withstand further price decline, they can withstand because they have actual money in their pockets. So they're buying the stock with real money, not with leveraged money, right? So they are actually getting in. They, in this stock market jargon, they are called informed investors. So in the accumulation phase, what happens? The informed investors actually get in, and the uninformed investors, the weak hands, actually wash out. So after that accumulation phase, what happens is a phase of rapid price acceleration. The actual bull market is seen in that phase. Prices keep on appreciating. Initially, some disbelief is there. People cannot believe that prices, after so much huge, protracted pullback, prices can really rise that much, right? So people initially cannot believe that rise, and that disbelief really fuels the price further, and prices keep rising, and that is the real bull market that is setting in. Uh, in this phase, actually, lots of momentum strategies make a lot of money, right? And suddenly, the economical news looks good, and good things start to happen. The fundamental of the companies, their revenue starts rising, and all those things are happening in this phase. Actually, market has discounted all these things, and that is why the bull market started in the first phase. The consolidation phase ended. So market is actually discounting these news as a bit earlier, sometimes 3 months earlier, right? So there is a 3-month leading phase when market discounts the fundamental good or bad news of the economy. So in this second second phase of the bull market, the real price appreciation is seen, and people get into the market yet again, right? But there is an euphoria seen in the last phase of the bull market, right? The prices of small cap stocks, those stocks that have no fundamental value, they have no intrinsic value, they keep rising like a rocket, like anything, and there is no fact to substantiate those movements. and that is the euphoria phase, and that is where the distribution phase occurs, right? Distribution phase is where the informed investors go out of the market because they cannot justify the further rise in prices anymore, and they are getting out of the market. They are taking their profits actually, and the uninformed investors, those who actually follow the price blindly, those who generally buy the stock just because it is rising, they are again coming into the market, and that is the last phase of the bull market. And that is how the bull market again becomes weak, because after a certain period again again the distribution phase will end, and there will be no more buyer and prices will start declining. Initially people will not understand why prices will be declining, because, and that is the beginning of the bear market, the next phase, right? That is the next phase, beginning of the bear market. Initially people will not understand why prices are declining, and they will not even believe in the decline. They have seen a protracted bull market, so they will still hold their losing positions, hoping for return for the price to their higher, to their buying level, or to an even higher level. But that will not happen, and again price will get strong downward momentum, and price will decline. That is what the rapid price declining moment occurs in bear market. That is when the panic sets in. People keep selling their stocks at whatever price they get. They just don't bother. They just want to get out of the market, and that is the second phase of the bear market. And again, at the third phase of the bear market, prices keep declining, but the rate of decline gets smaller. People get again bored. They just want to get out of the market, and again informed investors start to set in, and this cycle keeps moving on ever and ever. This cycle has been in movement for past 100 years or past 150 years, or for whatever year we have recorded price history. So these are the two phases. These are three phases of bull and bear market, and these things we can see in mostly all time frames. But these principles were first written as general tenets of price behavior by Charles Dow, and it happened in the 1890s. So these are the first principle of Charles Dow. The second principle is during any bull phase, there are three kinds of trend. Those are same, right? One is the primary trend. Primary trend is actually the fundamental direction of prices. Trend is only the direction of the prices. The primary trend is defined as the major direction of prices when prices keep rising in a primary bull market, or keep falling in a primary bear market for an extended period of time. This extended period of time just means it may be from 6 months, or minimum 6 months to 2 years, or even further. I have seen 4 or 5 years of bull market. So this is the primary direction of the bull market, and these are the primary trends. The second one is the secondary movement. During any primary direction, during any primary trend, as you can see it on my chart here, that during any primary movement is actually broken into several contra direction, several direction of price movement which is in the opposite to the primary direction. During a prolonged upward movement, prices sometimes decline. That is what we call pullback, and then again move in the direction of the trend. That is the resumption of the primary action. So these movements, these smaller movements, these movements generally occur for 3 months, 3 weeks to 3 months, as the saying goes on. These are generally called as secondary movement, right? So secondary movements are smaller movements. Those actually occur opposite to the direction of the primary movement. And third one is the noise. They are extremely short-term trends. These trends are extremely difficult to take advantage of. and these trends last for generally less than 3 weeks. But in today's market, these classification does not hold exact. Although the essence of the classification, we understand that trends exist almost in all time frame. But the classification time-wise is a bit no, is a bit backdated as of today. Uh, any trend we have seen, we can identify n number of trends in n number of time frames. So we even try to take advantage of 1 hour trend, which is beyond imagination in the time of Charles Dow. So we even try to take advantage of 1 minute trend, right? For some, there are some strategies for which even 10-second trend is long-term trend. So yeah, we are breaking down trends into several smaller and smaller time frames, and this is possible because trends show fractal nature. Fractal nature means whatever be the time frame, the nature of the trend remains same. So that is the second tenet of Dow theories, which says that any bull market or bear market is primarily composed of 3 trends, which is primary trend, secondary trend, and extremely short-term trends, which is basically noise. Let us come to the third most important Dow's tenet, and it says that prices discount all news and views that the market players hold. This is a bit this is a fact which is a bit long stretched. We should not take it on face value. We should rather say that prices not discount all news and views, but rather the prices try to discount. Prices try to discount all news and views of the market because prices do not know, the players of the market actually are not sure what the intrinsic value of a stock should be, and that's why the price always tries to find out its real value, right? If there is suddenly a good news in the market, if suddenly there is a good news in the market and the prices show a sudden rise, then what happens? Prices most of the time show some extended movement in that direction. I mean, traders mostly overreact, right? If there is a good news, then prices rise to a level which is not justifiable by that news, right? If there is a bad news, then prices become so depressed that they go to a level which is so poor that even that is not justifiable. Then what happens? Prices again keep rising or keep falling, and it is trying to find its real value. So it is not exactly true to say that prices discount all news and views. We should rather say prices actually tend to discount. Prices try to discount all news and views. So that was the third tenet of Dow. The fourth most important tenet of Dow is that averages must conform each other. What do we mean by that? Averages must conform each other. We mean in Dow's time, there was actually 2 important averages. The first one was the market index, and the second one was the railroad averages, which is the transportation index, right? The transportation index is integrated to the overall stock index in the sense that if if there is a bull phase in the economy, then the producers must transport their products to the consumers, and this should see a larger movement of freight. A freight movement rises in a bull market and the freight movement declines in a bear market. The railroads, the air traffic should increase, and this increment should be seen in the transportation index during Dow's time some 120 years back. Rails were the only viable communication process, freight transport process, so there was a railroad index. In today's context, this holds true. In principle, this holds true, but maybe the railroad index may not be the most important transportation index. Overall, we can see that auto sector should conform the upward movement in index, right? Auto sector or banking sector, these sectors, those are the leading index of an economy, right? Because auto and housing sector, real estate sector or banking sector, they are extremely rate sensitive sector. If there is a decline in interest rate, these sectors show a rise. If there is a rise in interest rate, these sectors will be weak and they will show decline. So in today's context, we can replace the railroad index of Dow's time with our auto index or banking index or realty index, or because all these index are rate sensitive, and they should conform the movement of Nifty or Sensex. Now, what do we mean by they should conform? We mean that if there is a bull market, and we are suspecting that is the beginning of a bull market, how can we suspect that? Because if prices go above an important previous top, right? And we can see series of higher bottoms leading to higher prices in the index and all major stocks. So that is the first point of suspicion that maybe we have entered into a bull phase. And these things, similar patterns, similar price actions should be seen in these sectors like auto sector, like realty, or like banking sector. So these sectors should also see some upward movement in price. The previous tops should be validated, or the previous bottoms should be lower, and we should see progressively higher bottoms in these indexes as well. So that is what is meant by the tenet averages must conform each other. Trends are conformed by volume. This is also an important parameter, and we have seen that in the direction of the primary uptrend, volume should rise, and this is an important confirmation parameter. In a declining market, this may not hold always true, because prices can decline even without a rise in volume. So that the tenet says trends are confirmed by volume is true for a bull market, but not always true in a bear market. So that was the fifth tenet. And the sixth tenet, which is also very important, says that trends are supposed to exist, or trends are supposed to continue until there is definite evidence that they have ended, right? This is more like a property of inertia, as we learned in physics, Newton's first principle that says that if something is set into motion, it will tend to continue in motion forever unless compelled by any external forces. Or if something is in rest, it will continue to be in rest until it is compelled to change its state of rest by any external forces. And these thing exactly applies to principle of trend as well. Uh, Suppose there is an uptrend. We have clearly identified an uptrend, by which means, say we have seen, we have identified the bottoms to be progressively higher. Say prices are consistently above some certain moving averages. So for whatever reason, if we have identified a primary uptrend, and we then should continue to believe that the primary uptrend is still in force unless there is some definite evidence. How could we get some definite evidence that the trend has reversed? First of all, there will be violation of an important bottom. This violation of a bottom will terminate the series of higher bottoms. There will be no series of higher top, higher bottom formation. So that will be the first evidence. Second is that an important moving averages will be broken, and those evidence, unless there are strong evidences like that, we will have to assume that the primary uptrend is in continuation. It is important to believe so because there will be intermittent pullbacks in the direction which is against the direction of the primary trend, as we told in our first tenet about the secondary movements. We are trying to take advantage of the primary trend, and there will be secondary movements which is against the direction of the trend. So these were the 6 tenets of Dow, and these principles were set not today but some 120 years ago. I'm repeating here that Dow, Charles Dow, which is said to be the four-figure, the father figure of technical analysis. He actually formed these. He actually observed these principles, but never formulated these principles in a coherent theories. His students in the latter part of 20th century formulated these principles into these theories. And these theories, why should we learn about these theories, which are more than a century old? Because these theories have stood the test of time. Because these theories have proven themselves against any kind of market. We have seen a huge bull market, we have seen huge bear market in the past 1.25 century, and it has been seen that a follower of Dow theory would have done pretty good, would have done more than average trader in generating a steady return from market if he goes by these principles of Dow theory, which is identification of the primary trend and trading in the direction of the primary trend. So having said that, having covered briefly the principles of Dow theory, let us now come back to our own market, and let us try to see how the principles of Dow can help us in today's market, in help us in navigating today's market, right? So whatever you can see on my screen is the daily chart of Nifty, and in this daily chart I have also plotted the moving average. Let me change the moving average. Let me take a larger value of the moving average. No, let me do it 200-day moving average. Here we go. The red one is the 200-day moving average. In the upper pane, I have plotted RSI. Why I have plotted RSI, that is another story I'm telling you later. First of all, let me try to formulate how, let me try to show you how Dow theory can help us in gauging the primary direction of the market. The diagram on my screen shows the daily values of Nifty since 2015 May till now, and you can see the zigzag function. I have also plotted here the zigzag function. What is a zigzag function? Maybe I had explained it earlier in my one of my previous seminars. Let me do it again here. The zigzag function has a filter, right? Let me show you. This is the filter of zigzag function. The 2% is the zigzag filter. It says that any movement which is less than 2% from top to bottom, from the highest point to the lowest point, any movement which is less than 2% is taken as a noise by this filter, and this filter will not show any noise. It will not show any movement which is less than 2% from top to bottom or from bottom to top. It will show any significant movement which are only greater than 2%. So by employing this zigzag function, we are effectively eliminating out all the noises, right? This 2% is a figure that we have set arbitrarily. You can even change it. You can even make it 5%. So doing that, you will lose further volatility and the trends. You can see the trends in more clarity. So it is up to you what kind of filter are you going to use. The objective is to find out the tops and bottoms. As you can see, with the 5% filter, as you can see, the bull market started from 2016 January. Why we say that? Because in this period, in 2016 January, an important bottom was made. Prior to that, in 2015 or the first part of 2016, prices were making a series of lower tops and lower bottoms, which is a classical characteristic of primary downtrend. So only after the 2016 January or early February, prices made two important changes. Prices did two important things. First was it went above the 200-day moving average. Here I am plotting it. Yeah. So in early week of May or early week of last phase of April, prices went above its 200-day moving average, and it was the first thing to do in past 7 months. So this was significant. The second important thing is that the last lower top was in third week of October 2015 at around this level of 8,300, and this top rather was also surpassed. Prices went above this top. This confirmed that the series of downward movement, the series of lower tops is finally over, because prices actually went above the last lower top. So when something of this kind happens, we can say for sure that since the series of lower tops no more exists, the primary downtrend is over. So these are the important signals that we can use to identify the beginning phase of a bull market. First, price will end the series of lower tops, and second, the price will go above its 200-day moving average. And both these findings conform to the findings of Dow theories, that the primary, that a series of downward trend is ending, and we have used here a 200-day moving average. Rather, towards the latter, I will see we can also get similar signals from RSI. These oscillators, we can take advantage of these computerized oscillators. These were not available in the period of tau. We can take advantage of these indicators right now. I am coming to this later, but for the time being, it has remained confined within the principle of tau. And then what happened is not only price stayed above the 200-day moving average for a larger period of time, but it also started to make a series of higher bottoms. As you can see, the first bottom was made here in December of 2016. The second bottom is made here in the March of 2018. Right now, price is trading at least above the March bottom, right? And it is also staying above the 200-day moving average. So there is not conclusive evidence that the uptrend has reversed, and unless there is any conclusive evidence that the uptrend has reversed, according to our sixth tenet of Dow, we have to believe that the uptrend is in force. Now, this is only a 5% zigzag filter. You can shorten this filter. I have shortened here now the filter to 4%, and now you can see the inside volatility a bit more. Now you can see the 4% filter has revealed a bit more number of tops and bottoms, and the series of higher tops and higher bottoms is visible here. Let's shorten it even further, and you can see that more and more tops and bottoms are being revealed in the primary uptrending phase, and this is what makes it so interesting, because if you can define your own time frame, then you can set your own filter according to your own need, and you can take advantage of the trend of any time frame, right? One can take a filter. One can set a filter of 5%. One can set a filter of 4%. With a 5% filter, what will happen? You will be able to catch the larger trends, and also your losses, average losses, will be higher, but the overall probability of success will increase. With a smaller filter, you will get more frequent entry and exit signals, and your profitable trades, number of profitable trades will increase, because you are taking advantage of the short-term volatility here, but the reliability of the signal also takes a hit, right? So there is pros and cons of both approaches. You have to find your own optimized value which is good enough for you, and you have to take your trading decisions accordingly. These are the principles that you can follow to find out your optimized values that I can show you. And not only, you don't have to go only by the conventional principles of primary, secondary, and short-term trends. You can find trends in any time frame, in weekly time frame, in monthly time frame, and in the shorter duration. You can find trends in daily time frames, in hourly time frames, in 10-minute time frames, in 5-minute time frames, in 10-second time frames, in whatever time frames you want to find out trends. There will be trends in your time frame. You only have to find out the direction of the trend by looking at the tops and bottoms. So if you can program the tops and bottoms accordingly. A computer can do that. A computer can find that. As you can see, the zigzag function is doing it finely for me. There are other techniques as well. You can take advantage of that. Volatility charts are available. You can take the advantage of Renku or Kagi types of charts. These charts I will try to explain later in some other webinar. Or you can take the advantage of pointed figure chart, which I do sometimes for my trading and all those things. So the objective is to find out the trend, the prevailing trend, and you can take in the direction of that trend. And this is how the tenets of Dow theory can help us in finding the primary direction of the trend. When an uptrend ends, what does it look like? So here you can see, let's increase the filter here. The filter is too short. Yeah. See, the series of higher bottoms is actually being violated here. The price is not important, the date is not important. Only look at the chart and look at the series of tops and bottoms here as found out by the zigzag function, which is here 4%. Yeah. So these were the higher bottoms. These were the higher bottoms, and on this particular date, which is the third week of March in 2015, the series of higher bottoms is now ended. Market is no more obeying the previous bottom. So that is the first signal that the uptrend is likely over. At this period, we can also see the charts of banking index or the charts of auto index, as we found out that indexes shall confirm each other, and we will observe similar kind of happenings. Those charts also violated these bottoms approximately the same time. So this is the first signal. Next, what will happen is that prices will come below the 200-day moving averages, which happened here in May, some 1 month later, and prices kept on making lower top, lower bottoms, and prices kept continuing below the 200-day moving average. And as you can see, this was the famous bear market of 2015. And during the entire bear market phase, prices kept on making lower tops and lower bottoms, even below the 200-day moving averages. So both these signals were confirming that prices should be below the moving averages, important moving averages, which is 200-day moving average, and the series of lower bottoms will be visible in the chart. So these things, the principles we are getting from the Dow theory, and we are applying this on today's Nifty chart, on today's index chart. So an investor or a trader who is just following Dow theory will be doing pretty fine, will be in the direction of the primary trend most of the time. So this is how we can take advantage of this century-old principle, right? Now, having said that, I will also like to draw your attention to one of the very important momentum oscillator, which is the RSI, Relative Strength Index. Maybe I had introduced this index to you earlier, but let me give you a brief introduction and how it can help us in gauging the primary direction of the trend. Is that RSI is something, Relative Strength Index, is something that it compares the price of a stock with its own price some 14 days ago by default. We can change the time period. We can make it comparing with its own price some 15 period or 20 period or 30 periods ago. So this, by doing this, we are creating an indicator, or oscillator rather, which will be confined within a value of 0 to 100, right? Generally, less than 30 values are taken as oversold, or greater than 70 value for RSI is taken at overbought. But I will suggest you not to take these values for granted. And here I am showing you why. Because many times you will be seeing that in a bull market, right? And this is what I'm going to show you here. And this is the most important signal of RSI that I'm going to reveal you, is that during the beginning of any bull market, the RSI will inadvertently go above the 70 level. Say for example, here in this period, this was the 2017 January, when market was just recovering of the 2016, end of 2016 pullback that occurred because of the shock of Donald Trump in USA being elected as the president, or some surgical strike occurring back here. in Kashmir or whatever. So market was in a shock, and it was coming down. It was showing significant sell-off, and this sell-off continued from September till December of 2016. And in the early part of 2017, prices not only violated the 200 DMA, prices not only violated the previous top, which actually more confirmed of the end of the previous downtrend. But look at the RSI here. The RSI actually went above the 70 mark, right? I have shown it here with a vertical line. The date was 27th of January 2017. So this happened for the first time after September, and September was the time when an intermediate top was made, and after that prices declined because of all those happenings in India and in outside world. And in last week of January of 2017, RSI actually went above its 70 mark. So you should not take this as a sign of overbought, right? Do not make that mistake, because this is more confirmation. This is more confirmation that prices are showing significant strength. The prices were in a protracted downward movement. After that, if RSI, which is I have used here the 14-day period of RSI, which is by default choice, and if RSI goes above the 70 mark, this is a mark. This is a mark which says that prices have got some strength. This strength should not be underestimated as a downtrend, right? This as a pullback of a downtrend phase. This is something that did not occur in the entire downtrend. This is something new, and we should honor this kind of signal from RSI, which say that this could be the beginning of a new uptrend. We already got the signal from the price itself when prices actually went above the 200-day moving average. The prices actually went above the last top. So this happened first time in the past 5 months, and this was the beginning of a new bull market. And look what happened in the following 12 months. The prices kept on rising, and RSI kept on going above the 70 mark for a extended period of time. For a number of time, it stayed above, right? And these signals should not be taken as strength of overbought, because we should not take signals like this. We have to identify the trend and trade only the direction of the trend. During such period, we will only mark what is the mid value of the RSI, and whenever prices or RSI coming below this mid value, these are taken as pullback, and these are taken as opportunities to enter long during a bull market. So we can spot here one trading opportunity here in last week of June of 2017, another here in mid-March of 2017, and these were some pullbacks, and these pullbacks started to wane out here. But anyway, RSI never came below the 30 mark, which said the bull market is pretty strong, bull market is intact. And in this phase, RSI went much above the 70. During the following phase, in March or February of 2018, RSI was showing weakness, but it never came below the 30. So although prices actually violated the 200-day moving average, but other signals were not there. The higher bottom, the last bottom was made here at around 97.35, but this bottom was made only at 99.98. So these bottoms were not broken, and RSI also did not come below its 30 level. Rather, it showed a slight positive divergence there, which I'll be explaining later. So RSI going above 70 is actually a signal of strength. It is not a signal of being overbought. RSI going below 30 is actually the beginning of a new downtrend. It is not a signal as oversold, right? So be very careful about that. And I'm using RSI as a trend identifying indicator, and this is doing quite well as a trend identifier, and this is again going in conformity with the Dow theory. So these are the auxiliary oscillators that we can take help of in finding the direction of the primary trend. As of yesterday, prices closed at 10,714. Since the uptrend was continuing, we will have to assume here it is still continuing unless something happens. We are not going to predict what is happening, what is likely to happen. We will only be ready that if these things happen, then we should say that the uptrend is likely over. What are those things? Let's break the zigzag in further smaller filters. Let's do a 3% filter, and we see that this was the bottom last time it was made, which is a 10,430. This bottom is made as of now 10,518. So 10,413 or roughly 10,400, and as long as this bottom is being honored by the price, the series of higher bottoms is continuing. First of all, the second one is the 200-day moving average, which as of now is again residing at 10,440. So the 10,430 and 40 regions is being very important. And last but not the least is the signal from RSI. RSI is right now showing a neutral value, which is at around 50 region. And if RSI violates these bottoms of around 37, and if it comes closer or even violates the level of 30, that will be signals more conforming to say that the bull market has ended and it is safe to now trade from the bear market. So that is how we use Dow theory in today's market in applying these principles to find out the direction of the primary trend and to trend in the direction of the primary trend. So I hope you liked it. I will appreciate queries from your side. If you have any query, you can post it in our YouTube channel. This video will be posted. And so signing off as of now. See you next week with a new topic. Thank you. Goodbye.